Hello, everyone, and welcome into crushthestreet.com. I am Kenneth Amador, and I'm joined today with Jeffrey Neilson, someone who's been on the show before and given us a lot of insight on the economy, finance, precious metals. And we're going to be talking about all of that today and more. His website is dynamicwealthresearch.com. Visit that website and visit him there. But to get an idea of what you can expect there, we're going to be diving into all things economic today. Where are we with precious metals? Where are we with the markets, maybe investor sentiment, kind of where we're all looking at, what is going on with trillions of dollars of stimulus, money printing, seemingly chaotic governments, but yet gold and silver are below their all-time highs. Silver 50% lower than where it was in 1980. I think a lot of people are scratching their heads wondering why it's underperforming over the last decade, the stock market and things like real estate in the face of just insane money printing. We're going to talk about that today. Jeff, thanks for coming on the show with me.
Always a pleasure, Kenneth.
Well, kind of set you up there with the background of, where we can start. I mean, they're talking about $1 trillion packages now. And I think that it's just become so disconnected to the average person. What is directly connected to the average person is a paycheck that they get to cash and spend on new shoes, new iPhones, maybe go to Vegas. But what they're not connected to is the trillions of dollars that's being added to our national debt. And maybe the connection to why in 12 months they might have to pay another $100,000 for the house that they could have bought this year because money is chasing hard assets in this environment. And so maybe you can address that to a certain degree here. I know it's a loaded question with so many things to talk about. We could probably talk an hour on this, but maybe we can chomp at the bit here a little bit and address that.
So let's simplify this and look at just real estate and precious metals. So as I was saying to you before we started the interview, I'm not doing this precious metals gig full time anymore, in part because I just got frustrated with all of the noise about precious metals. And I'm not talking about just the crap in the mainstream media. Even a lot of the alternative media stuff is absolutely useless because it's expressed in terms of the fraudulent monetary paradigm in which we live, the US dollar paradigm. That this worthless currency is the anchor of the global economy. It's a concept almost too ludicrous to contemplate. So when I discuss investing, I do so from the perspective of two words: wealth preservation. The problem is that's a principle of legitimate monetary system, something people have no exposure to. So when I say wealth preservation, people's eyes tend to glaze over, they go to sleep. It sounds like the most boring thing in the universe, but wealth preservation is actually the fundamental premise behind investing. So the reality is that when you invest your money and you look at the nominal gains you're achieving expressed in ever depreciating US dollars, the reality is that you're not making money. At best, you're preserving wealth. And so the best way to illustrate this is, in fact, real estate. So let's take Manhattan residential real estate. Go back 100 years. Look at the price then compared to today. So expressed in depreciating dollars, Manhattan residential real estate has notched a 10,000% nominal gain over that 100 years. But the picture is totally different when you actually price it in real money, in gold. So like I say, it's increased by 10,000% nominally in US dollars. Guess how much Manhattan real estate has increased over 100 years when you price it in gold?
I don't know.
25%. 25% over 100 years. But of course, you wouldn't actually get to net that 25% gain because when you own real estate, you're paying property taxes on the real estate every year. Unless you paid cash for that Manhattan real estate, you're wasting more money on interest on your mortgage payments. And then of course, gold is more liquid, it's portable. So over a span of 100 years, Manhattan residential real estate cannot compare to gold as an investment.
But are you leaving out rental income from that equation?
But so I mean, yeah, so yeah, technically you could be generating income off the property, but I mean, that's like, so that's an entirely different equation, because in fact, there's gold leasing. So, I mean, people can, the myth is that gold generates no income, but the fact is that people lease gold. So, I mean,
that's a good point.
So, I mean, it's when we get into secondary income that you're deriving from an asset, we're talking about something altogether different. So the other thing is that you can pledge gold to back, all sorts of other investing. So, and then drive income from that, because it's such a fantastic hard asset. It's the premier hard asset. So it's the ultimate collateral. So, getting into secondary income is kind of a misleading tangent, from the basic premise that in terms of the asset value itself, Manhattan residential real estate has not actually increased in value. It's done a very good job of preserving wealth, almost as good as gold. So if you start thinking of wealth preservation in terms of Manhattan residential real estate, then suddenly wealth preservation, and you start equating gold with Manhattan residential real estate, then suddenly wealth preservation sounds like a lot more exciting. Yeah. So, and of course, when you look at the prices, most of that increase in Manhattan residential real estate has been in the recent decades, just like most of the increase in the price of gold has been in recent decades. So it's not like this is an archaic comparison. It's a comparison that's held true over the long term for 100 years. So you can't judge gold, based over any shorter time span, even a period of several years. And one of the reasons you can't is because of the fact that, since gold and silver are precious metals, they are conserved rather than consumed. So, all of the gold that's ever been mined in the history of humanity is still out there in existence in the marketplace, minus what's been dedicated to religious purposes and other sorts of shrines, things like that, heirlooms. But so the fact is because there's such a huge pool of gold over any shorter time horizon, even a time horizon of several years, market distortions can make the picture look markedly different. And of course, when we talk about market distortions, we're talking about the ever-present manipulation of the gold market by the banking cartel, which has been exposed, in numerous ways. So, you don't buy gold for a short-term profit. You buy gold to preserve wealth, and because over the long term, it's going to do as good as any asset that exists in the world.
Yeah. Well, let me ask a couple more controlled opposition questions for you. I guess what's difficult for someone like me who's owned gold now for a while and believes in it, I share reasons why I think now is the time to be owning gold and silver, especially, is that we've seen gold, I guess, pale in comparison to real estate and stocks, let's say over the last decade. I mean, gold has gone down from its high in 2011. We're just barely getting back there. Meanwhile, stocks have gone crazy. And what's the other anomaly is that we're in this like hockey stick environment of craziness and money printing. So, in the face of news headlines that are saying inflation is coming, money printing, $3.5 trillion stimulus programs, potentially more lockdowns, Delta variant, even more lockdowns, even more money printing. I mean, all these things, and gold is just almost an afterthought in the back of our minds, and it's not performing. And so people are really demoralized in terms of their belief in gold as that historic wealth preservation vehicle.
So there's two short-term issues here that have really impacted the gold market. One of them is the COVID pandemic. So what did we see when the pandemic struck? So of course we had the typical crisis attack on the gold and silver markets, and the prices were driven down. Then we had the massive rebound, which we also see in this scenario, as of course the market rushed in to take advantage of these safe haven assets that were discounted by ridiculous levels. But then things got weird because of course the COVID lockdowns came in. And so I never even really thought about the significance of this at the time. But what did the COVID lockdowns do? Well, they kept people in China and India, the world's two biggest bullion markets, from going out and buying jewelry and going to bullion stores for several months. So that was a massive hit to gold and silver demand over a period of several months. And so that's one side of it. And then the other side, oh, what was the other thing I was going to point out here? Just slipped off the tip of my tongue. You know, I lost it. Yeah, you know, it's one of those things. Sometimes they just slip away. But yeah, so but even just the China and India factor, I mean, that was a major dynamic in reducing demand for gold and silver. And so you know, that, and of course, so the gold and silver market, of course, it's controlled by the big banks. The price only really responds to one thing, and that's heavy physical buying. Because the reality is that when all of the bullion is bought and it's gone, the game is over. You know, they could leverage bullion by any ridiculous amount they want, but they can't leverage zero. You know, so as long as there's plenty of metal around, they can go, you know, really aggressive with their manipulation games. And so it's all about physical demand. So when the physical demand backs off, even though we've been seeing heavy investment demand in North America, it doesn't offset the world's two biggest bullion markets seeing this major drop off. So, you know, that's been a major factor in keeping demand depressed. And so, but we're going to see that reverse now. And so that's, you know, that's been oh, sorry. And then the other thing that's been hitting demand, and certainly this is a bigger factor in the West, are cryptocurrencies. So this is where things get really hilarious. So cryptocurrencies are seen by the people that believe in them as alternatives and threats to the conventional banking system. Obviously, the big banks are aware of this. So what they go and do is every time a new cryptocurrency is created, they buy most of the supply. You know, what do you do if you're threatened by competitors? Well, you buy them out. So, I mean, it's so obvious. I don't understand why everybody else isn't seeing this. So when you see these massive spikes when cryptocurrencies are launched, it's the big bank cartel taking control. So they take control for several reasons. Obviously, because it's a threat. But secondly, when they control the supply, they control the trading. They can induce any trading pattern they want. And in particular, they can induce the massive volatility we see with these cryptocurrencies. So cryptocurrencies are not a threat to replace conventional currencies as long as there is massive volatility, because they cannot be used on a broad commercial basis when they're going up and down like this. As a company, you know, you can't afford to take a 20% hit on a particular month just from currency exchange, because cryptocurrency took a savage beating. You know, so they control the supply, so they can control the trading, so they can control whether these currencies are ever really adopted. And so we recently saw El Salvador make Bitcoin a legal tender currency. So what did we immediately see the next day? Well, Bitcoin was whacked by 15% or whatever. So, I mean, you know, who could have seen that coming? Well, maybe the people who know it's the big banks that are holding the supply, you know? So here's the thing. So on the one hand, they hate cryptocurrencies. On the other hand, they hate gold and silver way, way, way more. So they sit back, they let the cryptocurrencies bubble, because they know that we don't really have investors in markets anymore. We have momentum chasing gamblers. So when the cryptocurrencies are going like this, the dollars that would be going into gold and silver as the ultimate inflation shields are being sucked away by this hockey stick, or, you know, several of them. And so, of course, at some point, the game of musical chairs is going to end. The bankers are going to pull the bottom up from under the cryptocurrencies. And, you know, if you don't get out at the wrong time, you're going to get crushed. So, I mean, that's the reality of the matter. Cryptocurrencies have no intrinsic value. People talk about them having artificial value because they limit supply. But that's in essence a fraud, because it's only a legitimate factor if there's only a limited number of cryptocurrencies. It doesn't matter if each cryptocurrency has a limited supply if there's an infinite number of cryptocurrencies. Mm-hmm. It's just a different way of dilution. So the point is this fantasy that cryptocurrencies have intrinsic value is going to cause people to get brutally bashed at some point. Whereas gold as hard assets has only one ending, that it's going to do as well as the best assets at the end of the day. Yeah. So, you know, if you're discouraged by what happens over the short term, you have to become a big picture guy. You have to look at the finish line. And of course, the other side of it. So when people talk about chasing gains, that's aggressive investing. So we're in this period of ultimate craziness, ultimate economic uncertainty, threats to our economies collapsing, threat to our governments collapsing from debt. So what I keep telling people is in times of such chaos and uncertainty, you shouldn't be playing maximum offense in market. You should be playing defense. Don't go chasing hockey sticks. Go for the best wealth preservation vehicle in the history of humanity. Because at the end of the day, no matter what happens in all this chaos, that gold's going to end up as good as any asset out there.
What do you think about stocks in this environment, though, Jeff? I mean, I know stocks have done crazy, they've done well, but do you think there's truth to stocks being a hedge against this inflation that we're seeing with all this money that's being printed? There's more dollars with the same amount of goods and services, so of course stocks are going up. Is that logical?
So any hard asset is a hedge against inflation. Any hard asset preserves wealth. You take the wealth you earn in your daily wages, you put it into a hard asset, and that ounce of gold or that pound of copper is still an ounce of gold or a pound of copper a year from now. It preserves your wealth. So, so when it comes to whether an asset is a hedge against inflation, first of all, there's two issues. One is it a hard asset? So of course, real estate's a hard asset, gold's a hard asset. Most stocks reflect companies that have at least some foundation of hard assets. So there's a hard asset foundation in stocks. So whether or not something is an effective inflation hedge is it a hard asset? But B, what's the valuation? So of course, real estate is generally a hedge against inflation, but not when real estate prices, have raced, to ridiculous levels. Real estate is a ridiculous bubble, and a bubble can't be a hedge. So some stocks are in ridiculous bubbles. Apple's not a hedge, Google's not a hedge, Tesla's not a hedge. But if you look at gold and silver mining stocks that have been pushed down to, even more ridiculous valuations than gold and silver, so there's a hedge. Because we know where gold and silver is going to be at the finish line, and we know that the gold and silver stocks over the long term outperform bullion. So if you're looking for stocks to hedge against inflation, you don't buy the most expensive stocks, you buy the cheapest stocks.
Right.
You don't buy real estate, the most expensive hedge against inflation, you buy gold, the cheapest hedge against inflation. It's just simple, relative value proposition. And so gold and silver completely win right now. So for anybody, any serious rational investor, you don't look at gold and silver and say, oh, well, gee, they're not doing very well, I'm not going to buy them. If Manhattan real estate goes down 40% in price, are people going to, hold their nose and say, well, I'm not going to buy Manhattan real estate because it's too cheap? No, people don't say that. They say, gee, I'm going to buy as much Manhattan real estate as I can afford because I know it's worth something. So, Manhattan real estate equals gold. When real estate goes down, people like it. When gold goes down, you should like it. It's real simple.
Yeah. And just to touch on the investor psychology of that, when stocks are seemingly in this upward trend, and when it goes down, it seems like a buying opportunity because people are trained to believe it's going higher. Same thing with real estate. There seems to be a little more of a steady rise, whereas gold and silver, it kind of languishes for a while, or when it looks like it's going to go up, it goes down. And again, I'm looking at a shorter time span here, where I think real estate had a little more of it didn't like peak in 2008 and stay below that. Like we've gotten past where, it had hit highs in 2006, 7, 8, and we're beyond that now. Whereas gold, we're still below where we were in 2011. So it's that investor psychology where we don't really know if gold is in a correction. We know that, if you step back and look objectively, but emotionally, people don't know if they believe that. And so I think that's where we are with that. And, you can share some thoughts on that. I don't want to belabor the point too much, but I know what we're dealing with. I know what we're dealing with here.
Yeah, no, there's a definite point to be made. And the point is that because our markets have been totally overrun by the algorithms, which now control roughly 80% of trading, there's there's no connection between price and value. So when, we've been talking about value, that's one discussion. So now we're talking about price. So price today is a function of one thing, capital flows. So you alluded to it earlier, the money printing, vertical. So to understand how crazy that is today, we have to go back in time. So when I was covering, really into this sector and covering things closely, of course, we had Ben Bernanke doing his insane currency creation. And I would flash, the monetary chart of the US money supply on a regular basis because it was this hockey stick. Then in 2014 or 15 or so, we had Bernanke talk about tapering. And I was adamant that you cannot taper from an exponential function. That's a mathematical impossibility. When you get like this, that's the mathematical representation of out of control. Once you're out of control, only two things happen. You keep going straight up until you have this ultimate blow-off explosion, or you try to escape and you have implosion. Everything, the bottom falls out of everything. So the one thing that could not possibly happen is what Bernanke claimed he did. Tapered, and basically leveled things off. So in 2013, this is what the US money printing looked like. Well, if you look at the money supply of the US today, of course, with Powell, it looks like this. But 2013 looks like this. So of course, they've fudged the charts so much. So for one thing, they stretched out the axis. So 2013 looked like this. Today looks like this with the axis stretched out. If you compress the axis to the same degree as it was in 2013, what's happening today, would be absolutely vertical and it would be stretching to the sky. Like you couldn't contain it in a single chart. So, unless of course you totally crunch the vertical scale. So this is the point. So the money printing insanity today is an order, it's so much more extreme than what we saw when it was already out of control, that that the previous hockey stick is almost invisible. But of course, the other point is that all you see with the US money supply is this. Through 2014, 2015, 2016, there was no tapering. That was a lie and a fraud. So of course, once again, we have the Fed talking about tapering. And maybe they're going to manage to pull off another monetary fraud and show people a chart that looks to be going like this. But the reality is that when you see the money printing 5 years from now, it'll still be going steadily up. And the new money, and assuming the US dollar even exists in 5 years, which is extremely dubious, the new money printing chart will be like this. So we're still trapped in this exponential function. And of course, at this point, the Fed is showing no ambiguity that it's going for the blow off top. So we have all this liquidity pouring out of the Fed and pouring into where? I talked about it, real estate bubble, cryptocurrency bubble, bubble in large cap stocks. And then of course we have the ever-present black hole of the derivatives market. So you see, the reason we didn't have
and inflation too. I mean, we're seeing it in the price.
Well, yeah.
Of goods.
So let's address that. So we did not see the big wave of inflation when Bernanke did his monetary craziness. Why? Because they had more control over the economy at that time, and they were able to direct virtually all of that excess liquidity into the derivatives black hole. So the derivatives market went up like this in terms of total size and valuations, but the derivatives market is totally insulated from the real world. So that's why there was no inflation, no price inflation filtering out to the broader economy. The current scenario is totally different. And I told people, I've been telling people this for years, that the only one where this game can end, because as the economy gets more and more damaged by monetary policy, more and more of the money printing has to flow into the real world just to avoid complete collapse. And so we see that in spades with the COVID pandemic, where government support to the broader economy has been significant and dramatic and continues. And so when the money printing flows into the real economy, you get inflation. So, it's no surprise at all. The central banks pretend to be totally ignorant of the principles of a monetary system that the money printing leads to inflation. But of course, that is the reality. Milton Friedman famously said that inflation is always and everywhere a monetary phenomenon. Alan Greenspan warned us that in the absence of a gold standard, there is no way to protect savings from confiscation through inflation. So, it's not like this is a mystery. The central
Who takes that? Who confiscates it?
So inflation confiscates it. So it's I don't.
Is that wealth not transferred though? I mean, are we not seeing that wealth transferred to someone else?
So I can explain this in an extended metaphor if you want to give me some time. It'll take about 5 minutes. I mean, we got time to do that?
We do have 5 minutes. We're good.
Okay. So let's take a hypothetical example of Gilligan's Island. And for your viewers who are too young to know what Gilligan's Island is, that's a TV series about
I love Gilligan.
seven stranded castaways on a desert island. So on Gilligan's Island, Mr. Howell, the rich banker, decides that they should have their own monetary system. So he creates a supply of dollars for the island. He creates $700, $100 from each of the castaways. We'll call those Howell dollars. And the supply stays constant. So everybody has $100. There's a fixed supply of goods, a fixed supply of currency. So there's no inflation. There's no monetary inflation. Prices stay stable. But Mr. Howell, of course, being a banker, says, I'm going to pay myself $1 a month for running the monetary system. Well, even Gilligan can figure out what a racket banking is. That, eventually, Mr. Howell's going to have all the money. So Gilligan decides to create his own currency, called those Gilligan dollars. And he starts off and he creates 700 Gilligan dollars. So the first thing that happens is now there's a total of $1,400 on the island, 700 Howell dollars, 700 Gilligan dollars. So what happens to prices? There's the same number of goods with twice as much currency tracing it. So prices double. But if that was the end of the equation, then you'd have that one shock and it would level off. But of course, Gilligan doesn't understand the principles of the monetary system. And so realizing this, Mr. Howell and the professor, and of course, Mr. Howell, they have nothing at all to do with Gilligan dollars. So those three castaways continue using only Howell dollars. Meanwhile, you have Marianne and Ginger and the skipper and Gilligan using Gilligan dollars. So Gilligan says to the people using Gilligan dollars, you know what? We should raise our standard of living. I'm going to print up another 100 Gilligan dollars. And then we're all going to be richer. Well, no, because now instead of there being 1,400 total dollars tracing the same number of goods, there's $1,500. The prices go up again to reflect the increased supply of currency. Nobody gets richer. Right. But Gilligan doesn't stop there. It's like he doesn't, 100 didn't make us richer, so I'm going to keep doing this. So every week he starts creating 100 more Gilligan dollars. Well, what happens? So first of all, the Gilligan dollars don't really make people richer. That all gets confiscated in inflation. But what if you're holding Howell dollars? And all of a sudden there's 700 Howell dollars out there and 7,000 Gilligan dollars out there. The 700 Howell dollars, unless the Gilligan dollars have been devalued, the 700 Howell dollars have lost all their purchasing power. The wealth from the Howell dollars has been stolen by the currency creation of the Gilligan dollars.
Unless there's a demand for a more finite or
well, of course, we're on Gilligan's Island, so there's only a limited complexity in this system. So I'm dumbing this down so people just can see the principle here.
Yes.
So the principle is, that dilution has a price. Right. We understand dilution when we talk about stocks. Company prints a bunch of shares, the share price goes down. You've diluted the share structure, so the value of each share is less. But the central bankers pretend when they create more units of currency that the unit value of the currency doesn't go down. Well, of course it does. Right. Now, of course, because they can distort the markets, they can, and see, so here's the other thing. So we have all of these paper currencies that are all simultaneously depreciating. Well, relatively speaking, at any given time, one of those depreciating currencies can look higher than the other. So, the lying central bankers say, look at the US dollars increased in value. No, it's just been falling less fast than the other paper currencies. So none of these currencies ever rise in value. That's deflation. And deflation, of course, is not allowed because that causes all the debt bubbles to implode.
Mm-hmm.
We have all of these ever depreciating currencies with the relative value of these currencies fluctuating, creating short-term illusions. Some of them are actually rising in value, but they're continually plunging in value because money printing dilutes the currency, dilution reduces the value. And of course, when you do this, the people who are creating the currency are stealing the wealth out of the people holding the currency, just like they could do on Gilligan's Island.
Well, and that's so powerful. And thank you for doing that. I've been trying to articulate inflation and why it's so complex in my own way. And that was done very well. I mean, you have the greater good of the island, right? But in between there's people that benefit within that destructive structure. So that's part of the problem. Like, people can't just all agree that, hey, this is not good overall, because maybe you have people working for the government who benefit from money printing because the government prints and then pays their employees more, and they're able to keep their jobs and they get their raises, they get all their benefits, their programs. Even though the overall system is collapsing, there's people within the system that feel like they're doing better, which keep it going. And
well, it's very simple. So the closer you are to the printing press, the better you do. So the big banks, of course, are right on top of it. So they profit the most from this theft via inflation. But the governments are also very close to the printing press, obviously. So they do next best from theft via inflation. And then the wealthy are next closest to the printing press. So they, of course, do well by theft via inflation. So you see, when Greenspan issued his warning in 1966, Greenspan was this silly professor who was under the delusion that this quote unquote welfare statists were going to use inflation to steal all of the wealth from the wealthy and share it with the people. And this horrified Greenspan. I mean, to him, this was the worst crime imaginable. So then the bankers came to Greenspan and they whispered in his ear and they said, you know, Alan, it's actually the rich who use inflation to steal everybody else's wealth. So as soon as they explained that to Greenspan, he volunteered to lead the parade and became, you know, the greatest monetary criminal of prior to Bernanke and Powell and Yellen.
Yeah, I think that's what it is. And it's amazing how the people that are at the bottom, furthest away from the printing press, surrender their votes, surrender their willingness to allow this for the optics that this is greater good, the belief that this is all for the greater good.
They support the abusers. You know,
it's
completely abusers. Masochistic.
Well, Jeff, that was incredible. Please, if you would, share some thoughts. What is some of the latest projects you're working on? You know, and give us some, you know, closing thoughts here as to, you know, where people can find you, what you're working on, and, you know, if people visit you, what they can expect to find.
Well, so one of the reasons that I'm not that busy with precious metals these days is that I've gotten very involved in the psychedelic drug sector. And of course, with COVID, people are really noticing the mental health crisis more than ever. You know, it's a terrible problem. There's 2 billion untreated mental health disorders in the world today. And psychedelic drugs are going to revolutionize healthcare. You know, we're going from people unable to get adequate treatment for mental health to psychedelic medicine being able to cure these conditions, you know, often in just a few sessions. So it's going to revolutionize healthcare for 2 billion people. Plus, there's all these other applications. So I've been so excited by the potential of psychedelic medicine that I've been heavily involved with that. And I'm running a site called psychedelicstockwatch.com. So if people want to have a look at that, you know, and of course, there is an example of you know, what I tell people is a hedge against inflation. You know, this is a sector that, you know, can only go up because the mental health crisis can only get worse. There's no other options to psychedelic medicine to treat these conditions. And these stocks are actually at very compressed valuations. So, you know, we were talking about, you know, a stock as a hedge if it's cheap. Well, these psychedelic stocks are cheap right now. So, you know, maybe some of your audience wants to have a look at that sector and see what it's all about.
Absolutely. Well, Jeff, thank you so much for coming on the show. I totally agree with you. Yeah, we've done some diving into the psychedelics, and it's one of those misinformation sectors that the mainstream media have a hard time I think embracing, because they have their own agendas, they have their own methods as to what they want to support, and that's a whole other conversation. So that'll be for next time.
Yeah, you betcha.
All right, Jeff, thank you so much for coming on the show with me today.
Been great. Thanks.